November has been one of the worst performing months in the stock market so far this year, and Meta stock is down 6.8% and down more than 23% from its all-time high. Let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to calculate the intrinsic value of the company and potential future returns. I actually made a video about 2 years ago saying Meta was a huge opportunity at that price, which was around $110 per share. Since then, my investment has done tremendous, with returns of over 500%. I've recently sold all my position in the past couple of weeks like many investors, for some reasons that I'll explain later. Meta is one of the best companies in the world. Their revenue has grown in the past decade from $17 billion to $189 currently, which is a compounded annual growth rate of 27%. And analysts are still expecting high revenue growth, as they are expecting Meta to make $202 billion this year and reach $352 billion in 2029, which is a compounded annual growth rate of 15%. I agree with this outlook because Meta is growing on all fronts. Average revenue per user is growing and is now at $14. Family daily active users is at 3.5 billion. In terms of revenue by segment, the advertising revenue, which is where the majority of their revenue comes from, keeps growing and is now generating $184 billion. The reality labs sector, or the metaverse, has not seen a lot of revenue growth and is generating $2.3 billion. However, they have a lot of hope in this area and it has grown 9% last quarter compared to last year. On the other hand, payments and other has seen a lot of revenue growth in the past couple of years and is now generating also $2.3 billion. Moreover, we can see that Meta is a worldwide company as they are growing in the US and Canada, Europe, rest of the world, and where they have actually seen a decrease in revenue is in Asia Pacific. As far as profit, their net income has jumped from $3 billion 10 years ago to $58 billion currently. One negative aspect is that they have less free cash flow, as it is currently at $44 billion. Analysts are also expecting profit to keep growing, as they're expecting Meta to reach $39 per share in 2029. And I also agree with analysts on this view because Meta has outstanding margins, its gross margin being 82%, profit margin 30%, and free cash flow margin 23%. And we can conclude that Meta's fundamentals are phenomenal. Now let's see how the valuation looks to see if we can match the story with the numbers. And in order to answer this question, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a summary analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $317 per share, middle $536, and high $864. And because the stock is trading at around $603 or $604 per share, this means that if my low assumptions occur, you would get a negative 0.8% annual return on your money, middle positive 7.9%, and high 16.4%. Now, as far as my assumptions, I assume Meta gross revenue between 8 and 16% annually over the next 7 years, the average profit margin and free cash flow margin between 20 and 30%, and I assign the PM price to free cash flow at the end of the 7 years of 18, 20, and 22. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Meta is trading at a P of 26 and price to free cash flow of 34, and therefore we can conclude that Meta is now trading a bit expensive. And this is the reason I decided to sell and why I decided to buy the company then. As you can see, when I made the video back then, and the stock was near $100 per share, it was just extremely cheap according to a discounted cash flow model for such a great company. The same fantastic company but trading at a different valuations can give you either amazing returns or very poor, because in the long run what matters is valuation. Because Meta's fundamentals are amazing and they also have an excellent balance sheet with $44 billion in cash and $51 billion in debt, so basically no debt. And in conclusion, I decided to buy Meta at that time and sell it today because of the same reason, which is valuation. In investing, the more you pay for something, the worse your returns are going to be. The less you pay, the greater your returns. Lastly, If you want a discount on stockanalysis.com, the best place for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Meta stock in the comments, and I'll see you in the next one.